Previously, we've talked about mutual fund benchmarks. I want to get a little bit more out of you when it comes to explaining what exactly is alpha and what is beta.
Correct. Yeah, I think, Fatima, these are very, very important and pertinent questions. When it comes to benchmarking, the resultant outcome of benchmarking is return and risk. Alpha speaks of return, beta speaks of risk. Unfortunately, we use such complex words in the world of finance that they sound so intimidating for a person to not want to learn it at all. But I think it is worth an attempt because it's a very simple concept. Alpha is nothing but the extra return a fund manager generates over its benchmark. So alpha is the arithmetic difference, as simple as a subtraction between what is the performance of the fund and what is the performance of the benchmark. To illustrate, let's assume the benchmark delivered 10% return for a specific period. Let's hypothetically assume it to be a 1-year period, and the fund delivered 13%, which means that 13 minus 10, which is just a simple subtraction, which is 3 becomes the alpha number of that specific fund for that specific 1-year period. So this is as simple as it could get. It's just an arithmetic subtraction of the performance differential between the bench with the fund, and subtracting the benchmark's performance would give you the alpha, and the alpha could be positive, the alpha could be negative. See, alpha is the primary reason why you employ a fund manager to manage your money, right? So this is the prime requisite. Firstly, I urge all viewers or investors to take the driver's seat and understand this, because this is the reason why you pay a 2% fee in a regular mutual fund option approximately. So point one, please take this word reasonably seriously, because this is the prime reason why you are paying him a fee anyway. Point two is, should you even have a fund manager, or should you go into funds which are lower on cost, which don't have a fund manager? Those are called passively managed funds, and these funds where there is a fund manager using his or her intellect to create this alpha is called active management. When we are speaking of alpha, you need to know there is a passively managed fund which is called the index fund. There's another category of fund which is called the actively managed fund. As the name suggests, there's a fund manager. In India, what is the kind of expectation you can have from this group of 150 approximate fund managers is that they need to generate you 3% to 4% more than the benchmark they've set themselves against. So 3 to 4% every year, you should ideally make more than the benchmark, because your fee is 2%. So if you don't make twice your fee as the excess return or which the fund manager uses his or her capability to generate, it would not be a it will be unreasonable. As an investor, I would definitely expect a 3 to 4% alpha consistently. And then coming to your question, Fatima, over the past, I think the alphas in the last 20 years have ranged between 5% to 6% in good equity funds, which is phenomenal, unlike in US, for example, where the alphas are negligible. Last 1 year to 1.5 years has been a very bad year for mutual funds, where they have not generated extra return over its benchmark.
Feroze, I just want to look at a bit of what you're saying and contextualize it further. What is, in other words, reasonable expectations? You can sort of talk about it in quantity, you can quantify it, or you can sort of give a situational analysis of it when it comes to assessing alpha, beta, and also how do you sort of match client objectives and I guess personalities in terms of what they want from their portfolios to the type of alpha beta that you're discussing?
Wonderful question, Fatima. I think firstly the expectation of alpha. If I am a client of a mutual fund, my expectation would be at least 3 to 4% per annum. But having this expectation, I would certainly give my fund managers to deliver this expectation on a time frame of 3 years. If I expect him to deliver a 1.5% extra return every 6 months, it's unfair. So 3% alpha expectation, time given to the fund manager to prove this alpha and deliver this alpha should be at least 3-year time frame. Then coming to beta, and its interpretation from a risk standpoint and marrying it with objective. Beta, of course, again the name is a little complex than it should be called. Beta is nothing but the extent of risk which the fund carries vis-a-vis its benchmark. For example, if the beta is 2, that means that the fund is twice more riskier than the benchmark. If the beta is 0.5, it means that it is half as riskier as the benchmark. So it's such a simple concept that if you see a beta of 1.3 times, that means that the fund is 30% more riskier. So it is likely that if the fund falls X, the fund, so if the benchmark falls X, the fund will fall 1.3 times the same fall. So beta tells you the relative risk between the two, which is the fund and the benchmark. Alpha tells you the relative performance or return differential between the fund and its benchmark.